Everybody's been long euro yen after a monster rally, but with the yen basket near all-time lows and the Bank of Japan hinting at a rate hike, something isn't adding up. The weekly Elliott Wave count and a cipher pattern are both screaming end of trend, and if this level holds, the next big move could surprise a lot of euro yen traders. Let me show you why I'm stalking shorts instead of chasing highs. Welcome traders, I'm Ian Coleman and I'm one of the senior analysts at FX Street. I'm going to discuss both the technical and the fundamental outlook for euro yen. Let's dive into the technical outlook and discuss what we've learned in other FX Street videos. First, let's discuss the Elliott Wave theory. Now, the weekly chart shows the possible completion of a bullish Elliott Wave count. That is in 5 waves. The theory would then suggest we are near the end of the positive cycle and due a correction to the downside. However, we have no clear reversal candles such as bearish outside bars or an evening doji star formation yet. So this analytical view is putting us on an amber alert for a potential long-term change of trend. Next, we're going to look at cipher reversal formations. These are formatted when two Fibonacci levels collide. We've discussed this trading technique in one of our short videos that's been posted on our YouTube channel. We have the completion of a bearish butterfly at 182.62. These patterns will often highlight the end of a trend. With the Japanese yen trading close to its all-time low, do you think the Christmas low liquidity markets would be a great time for the Bank of Japan to intervene? I do. Traders often misunderstand is where there is good value, with the medium-term support not seen until 176.90. Selling the completion of the butterfly formation at 182.62 offers great value. The risk to reward setup using a conservative stop is a whopping 5.7 R. This is what I'm looking at. Let's do the calculation. Selling at 182.62 with a stop at 183.62 gives us a stop loss of 100 pips. We have a target or a limit level at 176.90. That is 572 pips away from our trigger. 572 pips divided by 100 gives us 5.7. By any standards, that is a solid trade setup. So we've covered the technicals. Let's look at the fundamental drivers. The ECB, or the European Central Bank, is expected to pause its easing in December, but it is in a medium-term cutting cycle. This offers a bearish bias for the euro over the long term. What about the Japanese yen? On Monday, December the 1st, in a statement from the Bank of Japan, the central bank said that they were weighing up the pros and cons of a rate hike in December. The Bank of Japan meeting and interest rate decision is on the evening of the 18th and through to the morning of the 19th of December. And any rate hike would be a big boost for the yen and thus euro yen bearish. In summary, the immediate bias is still skewed to the upside for euro yen, but the fundamental and technical outlook suggests there will be limited further upside pressure. The prime medium-term resistance level is located at 182.62. Selling rallies offers great risk reward. And the pro tip, yes, the trend is your friend, but only until the trend is over. What's your favourite FX trade going into the holiday season? Let us know in the comments below.